Time. How often have you uttered the words, "I never seem to have enough time"? Throughout a person's life, time seems to be an obstacle. But the problem isn't always that we don't have enough time. Some people actually have too much time. They live such a long life that they deplete their assets and eventually outlive their income. They may last longer than their money does. Welcome to a presentation on the Survivor's Benefit Annuity Policy, a 21st century annuity underwritten by American Life and Casualty Insurance Company, a member of the Conseco family of companies. This video is designed to help provide you with an understanding of the Survivor's Benefit Annuity and how it can help your clients deal with the financial problems associated with living too long. Likely you've had the opportunity to recommend fixed-rate products to help your clients deal with their financial challenges. Fixed-rate products offer many attractive advantages, including safety, but they also typically expose your clients to the risk of not keeping up with inflation. Variable products, on the other hand, provide the inflation-fighting opportunities for growth. However, they require your clients to expose their money to market risk, a risk they may be unwilling to accept. The Survivor's Benefit Annuity is different. It's a single premium immediate annuity where your client makes one premium payment and receives an income for life. But unlike some variable products, the payments your client receives are guaranteed to never go down. And unlike fixed-rate products, those payments may increase each year based on mortality and the interest that is earned. The Survivor's Benefit Annuity is a 21st century policy designed to help assure financial independence in retirement. It provides an initial income that is guaranteed never to go down, and a future income that may increase every year, year after year, for life. Not only do you have a product with features and benefits that prospects need and want, as an American Life and Casualty agent, you'll have access to tools designed to help you effectively demonstrate those features and benefits to your prospects. There is the Survivor's Benefit Annuity video, specifically directed to the consumer. And there's the Survivor's Benefit Annuity flip chart presentation. Fully scripted, you'll find that this presentation is a simple yet powerful selling tool. How large is the market for the Survivor's Benefit Annuity? How important is an increasing income when it comes to retirement security? Consider that at the turn of the 20th century, only 1 in every 25 Americans was age 65 or older. Today, as the new century approaches, it's closer to 1 in 8. And as the year 2050 rolls around, 1 out of every 5 Americans will be over age 65. Not only will a greater number of people turn age 65, these people will be living longer lives. Our most recent census data reveals that people past age 85 are the fastest growing segment of our population. The expectation is that people turning age 65 will live 20 years or more after retirement. Today, you can expect that some of your clients might spend more years retired than the number of years they spent working. How many will live so long that they will actually deplete or altogether outlive their assets? Even clients who planned well for their retirement likely have seen that their income is consistently losing its purchasing power. A loss that in most cases can be directly attributed to inflation, increased taxes, greater medical expenses, and unexpected nursing home care. To effectively present the need for the Survivor's Benefit Annuity, you'll need to illustrate the trend towards increased longevity and show your prospects how inflation, taxes, medical and nursing home care expenses work to undermine retirement security. The first several pages of the flip chart presentation are designed to help you with this task. The balance of the presentation is devoted primarily to helping you show prospects that it's through the benefit of association that the Survivor's Benefit Annuity is able to help provide a solution to the growing concern of depleting or altogether outliving one's assets. The benefit of association is the foundation for how any form of insurance is able to help people effectively manage various kinds of risk. Through insurance and the benefit of association, we can make certain that losses due to fire, accidents, theft, and premature death aren't financially devastating. Consider losses due to fire. Few people have the ready assets available to rebuild a home that is completely destroyed by fire. Fire insurance provides a way for us to transfer this risk to an insurance company in exchange for a periodic payment of a small and more manageable insurance premium. It's the benefit of association that actually reduces the impact of unanticipated financial loss caused by fire. A diverse group of people pay relatively small periodic premiums to an insurance company. The insurance company deducts its expenses and profits and puts the balance of these premiums into reserves. The reserves are then available to be paid to those who suffer losses resulting from fire. The risk of financial losses due to premature death can also be managed through a benefit of association. Again, a large, diverse group of people pay periodic premiums to an insurance company. The reserves that remain after the company deducts its expenses and profits are available to be paid to beneficiaries of those who die prematurely. With the survivor's benefit annuity, people who are concerned with living so long as to deplete or outlive their assets can also take advantage of the benefit of association. These people simply contribute premiums. Again, the company deducts its expenses and profits, and what remains are the reserves that are used to provide annuitants with an income for life. The amount of income that can be provided will be based upon assumptions the company makes with regards to the future amount of interest that the reserves will earn and the life expectancy or mortality of the annuitants. So far, the survivor's benefit annuity may seem to be just like any other fixed-rate annuity you may be familiar with. And while much of the structure is the same, there are some very important differences. Differences that directly relate to the survivor's benefit annuity's ability to provide an increased income to annuitants who live a long life. We'll use a page from the Consumer Flip Chart presentation as a basis for illustrating these differences. Assume, for example, that these 6 people represent all of the annuitants who paid a premium into the survivor's benefit annuity. After expenses and profits, the balance of their single premium payments go into reserves. The amount of the payments that are made to these annuitants is based upon 2 factors. First is the future interest rate that the company assumes it will be able to earn on the reserves. And second is the assumed rate of future mortality, or in other words, how many will still be alive in future years to receive payments. If these 2 assumptions are conservative, meaning that if the interest the reserves earn is actually greater, and or if more annuitants die sooner, there will be additional credits. With a traditional fixed-rate annuity, the insurance company might retain these additional profits. With the survivor's benefit annuity, the reinvestment of excess earnings and or mortality into paid-up policy additions result in the annuitants receiving increased payments called benefit credits. These payment increases become greater the longer an annuitant lives because there are fewer annuitants living to share in the benefit credits. It's really very simple. The survivor's benefit annuity provides an initial guarantee of base income backed by all of the assets of the company. This guaranteed income can never decrease for as long as the annuitant lives, and it may increase. Each year, surviving annuitants may receive increased payments called benefit credits. These benefit credits are in the form of paid-up additions. They simply represent a redistribution of survivor's benefit annuity reserves to those enjoying a longer life. Based on current interest rates and mortality, future credits are calculated annually and are used to pay these additional benefits, thereby increasing guaranteed future payments. What might this mean to a male age 70 who pays a single premium of $25,000 into the survivor's benefit annuity? Based upon assumed mortality and interest at 7%, in the first year, his annual payment would be $1,799. The annual payment at age 80 would have increased to $2,502. By age 90, it would be $6,294. And if he lives to age 100, the annuity payment for that year alone would amount to $33,739. Remember, these are the projected payments based upon the previous assumptions and a single premium of only $25,000. All policyholders will receive an illustration at issue that shows guaranteed payments, payments increasing from interest and assumed mortality, and payments increasing from interest and alternate mortality. The survivor's benefit annuity is a retirement product designed to provide an opportunity for increasing benefits to those who live to a ripe old age. Let's look at 2 examples. One is based on 80% of the previous assumed mortality, which you will notice produces less in additional benefit credits or benefit additions. The second example is based on 120% of assumed mortality, which produces more in benefit credits or additions. As with all annuity products, there are limitations and conditions that you must make certain that your clients thoroughly understand. Plus, there are limitations and conditions that may be unique to the survivor's benefit annuity. For example, survivor's benefit annuity is structured to provide the annuitant with payment for life, no matter how long that might be. But no payments are ever made to the annuitant's survivors. Withdrawals and surrenders are not allowed. Any payments illustrated are projections only. All survivor's benefit annuity payment illustrations, including the examples used in this video, assume that the currently illustrated non-guaranteed elements will continue unchanged for all of the years. You need to understand and explain to your prospects that this is not likely to occur, and the actual results may be more or less favorable than what appears on any illustration. The previous three examples show from a more conservative approach to a more liberal approach. The use of these three levels cover most case scenarios. The key factor is once a benefit credit has been applied, the payment can never be decreased, and the new guarantee will be the minimum guaranteed for life. Today, there are literally millions of people who are currently retired, or who will soon be retired, who are afraid that they may have not accumulated the assets needed to see them through a prolonged period of retirement. What should these people do? Should they take the assets they do have and use them up, possibly over the next 10 or 20 years? Possibly gambling that they won't live any longer? If they do, and they're wrong about their life expectancy, the final years of their lives will likely be spent financially dependent on their families or dependent on society. Do they take their retirement funds, assets, and the like, and place them in such a way that they may have the potential for earning better returns? A greater earnings potential usually goes hand in hand with greater risk. Risk that might take a large bite out of a person's important retirement assets and again make them financially dependent on others. We believe that a better approach to protecting against the financial challenges of living a long life is to allocate a portion of a person's retirement assets to the purchase of a survivor's benefit annuity. As we've illustrated, a relatively small premium can provide a fairly substantial payment to those who live for many years. The survivor's benefit annuity. It's kind of like old age insurance for the optimistic client who is searching for a way to secure a retirement with dignity for a long, long time.